What's up, ladies and gentlemen? Welcome back to the channel. Today's topic is really going to be centered around what the market is reading in the tea leaves when it comes to what the Fed says and what the Fed is actually saying. We are going to see a lot of panic between now and the end of June. Most of it's going to be severely under or unjustified, and most of it's not really going to have that much of an effect on a long-term portfolio unless you make a series of really bad decisions between now and the end of June. And let's talk about that. We're already starting to see, based on some numbers that were reported last week, we're already starting to see articles come out stating that the Federal Reserve has failed, that they haven't anticipated this or they haven't anticipated that. And I'm here to tell you that the Federal Reserve has actually been remarkably steady about what they're saying. They've made really one big pivot in the last 2 years, and that was the switch over from saying that inflation was transitory to saying that inflation is here to stay for a while. The focus remains on fighting inflation. They do not really care about your personal investment portfolio. Fighting the Fed is going to be detrimental to you. And if you focus on what other folks are saying short term in the market, it is going to hurt you. And I have a video that I wrote the script for already that I'm coming out with in the next couple of days that sort of outlines the big signs of a market bottom and sort of the big signs. And consequently, if you took the reverse of those 6 different indicators, it would outline the signs that a market top is about to occur. We're actually nowhere near any one of those extremes, and I'm predicting a lot of sideways movement with some pretty violent ups and downs in the next couple of months. But I really don't expect the market to retouch those S&P 35 or 3,600 lows, and I don't expect the S&P to go over about 4,200 in that time period. And really, 3,800 or so might be the low for the S&P 500 in the next couple of months, which that low will probably happen sometime in March or April. Okay. And a lot of it is because just some of the really big signs that we have about market conditions going forward 6, 9, 12 months, they're not there yet to suggest that people have reached sort of max pessimism or anywhere near max optimism here. People are very, very cautious about what's going on in the market. So feel free to chime in anytime you guys want with comments. But what we're going to talk about is this article here, where it talks about what everyone got wrong about the economy and the ominous implications for the Fed. So basically, they're saying that efforts to tame inflation haven't worked yet. Brace for more pain and a harder landing. Now, if you've been watching my live streams for a long time on this channel, you would know that from the very, very beginning, I have stated that the mythical soft landing for the economy doesn't actually happen. In fact, Jerome Powell kind of talked about 2018, where they engineered sort of a soft landing for the economy. That never really happened. We had, I think, the S&P was down about 4% for the year, but the economy itself the rails didn't really come off. There wasn't a recession of any sort, and we didn't have that soft landing. It was just sort of a temporary bump in the market while the Fed stepped in to rescue the bond market. That is not how you would characterize what's going on right now. It's completely different. And in a lot of ways, the Fed is flying blind. That by itself is not new either. The Fed has essentially been flying blind when it comes to a lot of issues since about 1980, when Paul Volcker decided that interest rates were the way to control inflation, and engineering a recession by raising interest rates and making capital very expensive was the way to engineer a recession. That was the first time it had really been tried in earnest in history, and it was all theoretical. And to a large degree, he turned out to be correct about that. But what we ended up doing was trading high inflation for high increases in our national debt, which is something that's not sustainable either. So the one conversation that nobody seems to be having right now, but the Fed is moving forward with on a plan, is of course what to do about our national debt and what to do about the Fed's really large balance sheet. Be prepared to see some action on that later on this year. We're already seeing action like that right now. The Fed is allowing a balance sheet roll off where the $9 trillion or so that they have in U.S. bonds, as those mature, they're allowing those to roll off the balance sheet, and they're not going out and buying new bonds. They're basically just hoarding the cash on their balance sheet, taking that cash out of the economy. So basically, this article goes on to state that say that, hey, it's been about a year since the Russian invasion caused an oil price shock, and the Federal Reserve kicked off its interest rate tightening campaign, forecasters began warning in earnest that the US economy is on the brink of a steep downturn. Now, we did see a decline in the stock market through all of 2022. What we did not see really is a measurable decline in the economy. What we've seen is basically steady increases in economic growth over that time period, especially when looked at over a longer period of time. But Goldman Sachs economists were looking at a 20 to 35 chance of a recession within 12 months. JP Morgan Chase CEO Jamie Dimon was bracing for an economic hurricane, which he's come out and said, well, that hasn't happened either. And the Bank of America basically predicted a mild recession that would hit before the year's close. You can look at the second and third quarter of 2022 as a really mild recession if you want to, because the GDP did contract under inflation adjusted metrics in that time period, but we didn't see the crash in employment numbers that generally happens with a recession. So in a lot of ways, like maybe the definition of what we have as a recession simply being 2 consecutive quarters of economic contraction, maybe that is a bit simplistic. So the depressing outlook dragged down consumer sentiment, and roughly 3/4 of Americans felt by late fall that the country was already in recession, when in reality we were already out of that little mini recession. And none of that actually came true. Instead, consumer spending started to rise. The unemployment rate fell below its pre-pandemic low, and the government reported last month that the U.S. economy grew 1% from fourth quarter of 2021 to fourth quarter of 2022, 5 times the level that the central bank predicted just a few months before. They were basically saying that over the course of a year, there was going to be about a 0.25% contraction in the economy, which didn't happen. The question of how the U.S. economy has been able to defy gravity and stave off recession has dominated the conversation among professional prognosticators and given rise to a volatile economic environment, one in which a single data release can send markets soaring one day and plunging the next. And that is something that we've seen really since about October, where one set of data causes, market elation. The next day there's absolute despair. And I'm telling you that based on the 6 sort of economic indicators that traders normally look at to say when we hit max pessimism, we haven't even come close to those. And I'm going to talk about 2 of those indicators today, and we're going to look at charts. And these are probably the most important ones, even though nobody likes to look at these because they're really boring. They are one of the best indicators. So basically, they're flying blind and trying to feel their way in because they don't have an explanation as to why we've raised interest rates up to 450 basis points at this time, and the federal funds rate between 4 and 4.5%. I think it's at 4.57 yesterday based on market action, but it hasn't had that much of an effect on inflation. So it has had the exact effect, though, that the Federal Reserve is really predicting. They are never going to predict a straight line decline from 9% inflation down to 2% inflation without any bumps in between. And that is kind of what we saw last week with those bumps. It's going to be a jagged line down when it comes to inflation. There's going to be months where it doesn't look good, weeks where it doesn't look good, and weeks where it does look good. But the overall line is trending down at this point. And it has been trending down since we really saw the slowing of the acceleration of inflation started in February of last year, meaning that the rate that the inflation was increasing slowed down in February, March of last year. It probably peaked sometime in June to August of last year and has been declining since then. And we are going to continue to see some months that look good and some months that look bad. But neither one of these none of these scenarios right now are putting us in the situation where we look like we're going to see a huge run in the market, or we look like we're going to hit bottom again, right? None of the indicators are there to suggest that. So percent change in personal spending compared to 2010 to 2019 trend. As of December, spending on services still remained 1% below its pre-pandemic trend, suggesting potential room left to grow, meaning that there's possible room left to grow in the economy. Excess consumer savings and an ebullient labor market fueled demand for travel. restaurant dining, and other services where spending still has room to grow. And years of low interest rates have transformed the debt dynamics for an overwhelming majority of households, leaving them largely shielded through fixed rate mortgages from the impacts of the Federal Reserve's primary tightening tool. That's actually a pretty important statement there, that we don't have the amount of people that were on adjustable rate mortgages in 2022 that we did have in 2008. There is not going to be the giant wave of defaults that we saw in 2007 to 2008 in the real estate market. What we're looking at here is probably a relatively modest decline in prices and a modest decline in economic activity. This is not part of the Fed's plan for a soft landing. This is how market conditions have changed since 2008. Market conditions for real estate don't look anything like they did in 2020. So if you're expecting, market decline or property declines by 50%, like happened in some areas here where I live, or even greater than that in areas like Arizona, that is not likely to happen in this time period. So, how long do you think it will take the Fed to get inflation back to 2%? I think consensus is no time soon. I think consensus is no time soon as well. There are a few outliers out there like Kathy Wood that think that deflation is a huge issue and we could see a massive round of deflation coming soon. I don't see that, even though the M2 money supply is dropping like a rock right now. It has a long, long way to go before we have significant amounts of cash taken out of the economy. So I would say that probably safest bet would be end of 2024, beginning of 2025 would probably be the earliest that we see inflation back down to 2%. But let me put it this way. The difference between 2.2% and 2.34%, which is where inflation has averaged over the last 30 years, is actually fairly significant. I say that it's we may not see inflation below 2.5% for years and years and years and stick there. There's a lot going on in the economy that, especially when we look at the process of deglobalization, which is not going to be complete deglobalization. It's going to be high value items that we manufacture overseas right now. We're probably going to concentrate on manufacturing them a little bit closer to home. The whole world is going to be doing this. China is going to be doing this. Russia is going to be doing this. The United States is going to be doing this. Europe is. Many other economically important countries are going to. That is probably actually going to fuel an explosion of sovereign debt, and which is not going to help us when it comes to controlling inflation. Meaning that in the rest of the world, we're probably going to see debt to GDP ratios become a lot higher. And a lot of that has to do with folks trying to shore up their economic fortress. And there are a lot of different ways that's going to happen when it comes to acquisition of raw materials, being able to manufacture things that are critical to your economy in a manner in which you can control. This is the one way that I think Peter Zeihan is like absolutely correct, is that process of deglobalization further up on the manufacturing scale in terms of complexity, in terms of value, that's already happening. And a lot of that, when you look at battery manufacturer and automobile manufacturer, electronics manufacturer coming back to the United States, that trend is not going to end anytime soon. Okay. So basically this article is stating that the long trails of fiscal stimulus, the increases in tax returns, all that's coming to an end, and they think that is kind of what's contributed to this over the long term. But really, that everyone's kind of scratching their heads, and no one really knows what's going on. So when the Federal Reserve raises interest rates, it's looking to slow down consumer and business activity. Really, business activity. It's really business activity because when you're looking at return on investment, when it comes to a business, you have to look at achieving excess return over the amount of interest that you're paying on the loan, and how likely is that? And that's why a lot of loans aren't going to be made. Basically, when it comes to consumer loans, if you can afford to make the interest payment, you're likely to take out the loan, right? There's a two-part calculation when it comes to a business, which for the last 12 years or so, that two-part calculation hasn't been there. It's just been a one-part calculation, which is whether or not the business can afford to pay back like 0.25% interest or 0.5% interest annually on that loan. Now that's all changed with the cost of capital being at 5%. How much return do you need to get on borrowing that money in order to just pay the interest on the loan, plus make that risk you're taking worth doing. So a lot of that's what they're really looking at doing right here is targeting business lending. Business lending is if it declines is going to slow down employment, and that's how personal spending is going to be affected. Now they don't want to say that the solution for increased inflation is actually more unemployment. They don't want to say that out loud, but that is what their goal is. But the thing is, they actually do say that out loud. And they do say that out loud in things like the Beige Book. Okay. And we'll go over what the Beige Book is, but that is really, and that's the Beige Book is something that's printed 8 times a year by the Federal Reserve. It outlines what current economic conditions are and what their likely path forward is. So you're going to get their opinion on all of the data that they have in a paper. You can get it in HTML or PDF format. It's put out 8 times a year, like I said. And that is their actual view of what the data looks like from like a 30,000 foot view for the entire economy. And then it's broken down in like 12 different regions. And that is really the Bible for what the Federal Reserve is going to do. I wouldn't pay all that much attention to what different people in financial media are saying what the Federal Reserve is going to do. Just refer to the Beige Book, and that'll tell you right there what the Federal Reserve is going to do. Okay. So rate hikes before recessions, and I don't know if you guys can see this, but these little gray areas right here are the rate hikes. So anytime we have pretty big rate hikes out there, that's generally when we've seen the recession come afterwards. Right? You see that there is a degree of correlation here. It's not perfect when you look at right here. You look at right here. Also, we haven't reached the and this 2018 spike right here is the one that Jay Powell takes credit for, a soft landing, which we had a year of stock market declines of 2018. I don't think we had a single quarter of declining GDP. So I don't think it's really fair of him to sort of like take credit for basically a soft land in the economy of 2018. That was something as a totally different animal. In this case right here, we're looking at the federal funds rate in February hitting 4.57%, which is lower than interest rates were before any other recession, although that piece of data may not be all that useful since we've seen a steady decline in interest rates over the last 30 years or so. This was a very, very long period where money was very, very cheap. Okay. So our expectations of what a normal interest rate regime is supposed to look like are fairly wild. Prior to, if you look at this period right here, which is kind of the period where I was first thinking about buying a home, at no point would I have able, at least when I had the money, was I able to buy a home for interest rates less than 6 or 7%. So I think the first home I bought, because of how I finance it, it was at like 9.75% interest. And so it was pretty amazing. But we are seeing a little bit more pressure now as things like consumer debt dynamics are starting to change, like credit card debt. We are seeing increases in credit card debt. How much of that is just due to the increased interest rates on credit card debt versus how much people are actually packing on there in terms of extra spending is not really understood. But that's one of the things that the Federal Reserve is taking a look at too. Look at here right now, the two biggest and also most boring indicators of whether or not we are close to a market bottom or a market top. And one of them is the difference between investment grade corporate bond yields relative to the 10-year treasury on a constant basis, right? When that hits roughly 2.5% or so, that's when it looks like we're very close to a market bottom. When it gets very, very low, that's probably when we're close to a market top. This is, of course, 2020. I wasn't able to pull later data out of this, but at least in a graphic format, but I went back and looked at it in terms of text. It's basically whenever the spread between AAA rated corporate bonds and 10-year treasuries on a constant maturity basis hits about 2.5%. That's when you're going to say there's a lot of fear out there about companies not being able to pay back their bonds. And there's a lot of fear out there about further declines in the market. What that generally indicates, though, is that the fear is actually maxed out and that the market is close to a bottom, even though that's not how people feel, right? People do weird things when they're at their most fearful, when you should be your most greedy, okay? Right now, that spread is at 0.80, 0.82, 0.83%. So nowhere near that 2.5% spread. So there is not enough pessimism in the market for me right now to say we're probably at the start of a new bull market. And new bull markets really happen when there's a lot of pessimism. Okay. The one that I like better than this is actually the spread. And this is actually a graphic, guys. It's a spread between BAA corporate bond yield relative to the 10-year treasury on a constant maturity. So this is a measure of the spread between junk bonds, or what they call high yield bonds. Junk bonds are now called high yield bonds. And that's really just a marketing trick. But they're still junk bonds. It means they are below investment grade credit quality. It means there is a significant risk. Significant meaning I don't know what the actual number is, but it's not that significant. It's like a greater than 10 or 15% chance that there is going to be a default, or these companies will go out of business, right? So if you look, whenever this gets to be about 4.5%, that's when that indicates an absolute bottom in the market, and the market's probably going to turn around. And that's generally when pessimism has peaked. And you can see that this is kind of what happened on March 20th of 2020. And shortly thereafter, we saw an amazing bull run in the market. Right now, this has actually been declining to about 1.86% average on this. And this is not a full reflection of average. Average over time on the spread is roughly 2.6%. So if we look at the average on the spread, we're below that. We're below the peak pessimism here. No indication here that we are actually near a market bottom. And I think that we see a pullback in the market. We're going to see a huge, and if we see a corresponding pullback in the market and a huge difference in the spread between junk bond yield relative to 10-year treasury on a constant maturity basis, then we're really looking at probably a bottom. And this is one of my favorite indicators, probably that no other financial YouTuber is talking about, because they know that the subject of fixed income makes people's eyes glaze over in boredom. So that's all I'm going to cover on that. So I'm coming out with a video, like I said, later this week on the 6 signs of doom. And the 6 signs of doom are actually a contrarian indicator. When all of these 6 signs of doom say that the market is finished, that is when it's most likely that the market is going to turn around and we are going to see a sustained bull market. And those stars haven't quite aligned in the last year, even though we've seen a really big decline, particularly in the NASDAQ. The stars haven't quite aligned. We are looking at, I think the next couple of months is going to be interesting. And if I had to guess, I would say that the combination of the Fed not doing what the market expected the Fed to do in January, and the debt ceiling fight by June 30th, that is going to provide a great opportunity to pick up stocks really cheaply. The imaginary fear of U.S. default on its debt, and the Federal Reserve not pivoting on interest rates, that is probably what's going to send the market down quite a bit. And I think that's going to be your last great buying opportunity of this this bear market period. And I think that comes sometime between now and the end of June. Okay. Yeah. And then every once in a while I go through Wall Street bets, and this, and most of the time I do it just for entertainment. But a lot of times you find some nuggets here, and this is a good graphic. So Fed tightening always breaks something. The S&P 500 will drop to 3,800 by March, warns Bank of America strategist. And they basically just say that every time the Fed tightens, you are going to see a crash at some point. And that is, of course, what you saw in terms of the S&P 500. This does not mean a crash in the economy. It doesn't mean a pullback necessarily in terms of GDP growth. What it means is we're going to see a market decline to some degree. I think 38 by 100 by March. I think that's a safe bet that between now and the end of June, we touch 3,800 again. I think there's just enough fear in the market that people are reacting a bit more irrationally than they have in the past. And there's so much uncertainty that that could happen. You can choose to look at this as, oh, this time it's different, which it's never really different. Or you could choose to look at this as an opportunity. And this is one of the things I said at the depths of the crash of 2020, is that you're going to make more money by investing today than you will for the rest of your life. While I don't think that's the case this time, you could probably make quite a bit of money by sitting on cash that you have until we see some of this uncertainty shake out by the end of the debt ceiling fight. And I think you're going to have some opportunities here for quite a bit of money. But yeah, like great questions in Wall Street Bets. Do you think it's a good idea to study the market while on acid? Uh, no, I don't. Um, but yeah, I'll take a look at what's on Wall Street Bets because it's just kind of funny. Tesla always makes money. 1,000 shares, market value 204,000. You're up 60.55%. Excellent. All right. So the last thing I wanted to cover on this is, like I said, this is where you before the beige book. The beige book. I wish they had. I mean, they couldn't even name it anything more exciting than the beige book. This is the most boring name for anything on the planet, right? But if you go to the Federal Reserve's website, go under monetary policy publications, and beige book, this tells you everything that you need to know about what the Fed is actually thinking. That week, it's only 8 times a year. This last one came out on all the data was collected before January 9th, 2023. And basically, the overall economic outlook by that time was that overall economic activity was unchanged since the previous report. 5 districts reported slight or modest increases in overall activity. 6 noted no changes or slight declines, and 1 cited significant decline. On balance, contacts generally expect little growth in the months ahead. Consumer spending increased slightly, with some retailers reporting more robust sales over the holidays. Other retailers noticed that high inflation continued to reduce consumers' purchasing power, particularly among low and moderate income households. Auto sales were flat on average, but some dealers noted that increased vehicle availability had boosted sales. Tourism contacts report moderate to robust activity, augmented by strong holiday travel. Manufacturers indicated that activity declined modestly on average. So basically, there is zero exciting happening in the economy by January 18th. And I don't know when the next publication of the beige book comes out. I think it actually comes out in March, like middle of March. And I suspect that they're going to announce the same thing, that very little exciting happened in this time period, despite the fact that headlines look pretty exciting. Nothing really exciting happened in the economy. So this was probably one of the it has a lot to do with some of the things I've been talking about in a couple of weeks, although this headline is absolutely stupid. Warren Buffett capitalism. That's a really bad headline. But what he's talking about is the difference between what earnings expectations are and expectations, and how those numbers basically, because of GAAP reporting requirements, you're required to report those numbers, like expected earnings and all that stuff, and you're required to produce projections. How those projections are really easily manipulated to make your current earnings look a little bit better than they actually are. We are going to see a lot of those shenanigans over the next year, so companies can look like they're exceeding earnings on a regular basis. Be very wary of companies that are reducing expectations right now or giving really low guidance right now. Their goal is not to prepare you for actual earnings declines. Their goal is to look really good next quarter when they report earnings. All right. And this is absolutely market manipulation, but it's a form of market manipulation that we don't really have a good way to control at this point. Warren Buffett makes the point in this article that this is one of the best ways to manipulate consumers and markets, and that basically your priorities are misaligned here, meaning telling you are incentivized for not really being honest, because most of these executives have a tie to sort of stock-based compensation plan, and in order to keep the stock price high, you need to appear like you are exceeding expectations. Usually when times are pretty good and your company's actually growing at a really good rate, that's not so bad, right? Times like now, where you use manipulation to mask the fact that you aren't really growing at greater than a 1 or 2% rate or something like that. But since you reduced earnings expectations, to 5 cents per share per quarter, now you've exceeded those at 7 cents per share per quarter. That's a 40% outperform in terms of estimates. It actually be so you need to evaluate the earnings expectation and their beats over a longer time period than just a single quarter. And this is one of the things that he talks about when it comes to if you looked at earnings from last year from Berkshire Hathaway, what their earnings looked like based on earnings expectations quarter by quarter, and then what they looked like at the end of the year, Berkshire Hathaway's operational profits looked amazing. In fact, it may have been, I think it was a record year last year for them. And it really wasn't reflected in its quarter by quarter earnings. But anyway, so last time I want to talk about that, when I'll address a few questions here before we talk here. So if you look at the Fed checkable deposit and currency held by the bottom 50%, there's still plenty of stimulus money waiting to be spent. It's double what it was pre-COVID. Yeah, I haven't actually looked at that particular number in the past couple of months, so I can't really comment on that. So part of that is stimulus money. Part of that is actually, stimulus money in the form of the increased tax refunds that people got last year, which they're not going to get this year. A lot of that money is probably going to be spent by middle of this year. And at that point, I think that's when we see the actual decline in consumer spending. And what a lot of people don't realize either is the so-called tax refunds that you got last year for the vast majority of Americans, something like 61% of Americans that received that increased amount of tax refund. It wasn't a refund at all. It was just free money. They call it a refundable tax return, but it's really just free money. It's a tax credit if you actually paid the tax. If you didn't pay the tax, it's just free money that you don't have to pay back. That is the case with the earned income tax credit. That is the case with a lot of the tax credits from last year. That is the case with the child tax credit. That's all of those. If your income is under certain limits in the United States, it is a poverty reduction program that they don't call welfare, but it is welfare. If your income is under certain amounts, and shockingly, something like it was a little bit lower last year, but it was 48% of the people were under the amount where they didn't have to pay any taxes at all. That number is sometimes as high as 53% of Americans not paying any taxes at all. And it gets as low as about 46% of Americans that don't pay any taxes at all because their household income just isn't high enough. And a lot of these people are, a lot of Americans are not only not paying income taxes, they're getting free money from the government every year. That is not something that's recognized or understood by the vast majority of people in the United States. And I think it's actually damaging to the conversations we have about what poverty actually looks like in this country. A lot of people are not in the middle class, they're in the lower classes, whether or not they realize it. If you ask anyone in the United States which class they're in, and a lot of people really don't have a good idea of what classes are, no one will tell you that they're rich. Everyone will tell you that they are middle class. And you have people that make $500,000 a year that will tell you I'm middle class, upper middle class, right? You're not. I think that the top quartile of income in the United States starts at right around $100,000 a year, meaning that if you're in a household, you make more than $100,000 a year, you are in the top not top quartile, top quintile of income, meaning that you are in the top 20% if you make more than $100,000 a year. Everyone else is below that. You're in the bottom 80% at less than $100,000 a year. This is what people don't understand about wealth distribution in the United States. We have this huge bottom, this huge base, and this is Anyway, I could go on and on for this, but not going to do that at this point. I actually don't have a problem at all with checkable deposits held by the bottom 50% being huge. This is the backbone of our consumer economy. The only time I have an issue with this would be something like right now, where we have a lot in the way of inflation. Unfortunately, I think that a lot of that money is going to be sucked out of those accounts by midsummer of this year. There's going to be changes we saw a shift in consumer patterns last year where people weren't buying stuff. So we saw modest declines in manufacturing. People were buying experiences. So we saw increases in services in the economy. Where spending goes now, I'm not really sure. But one of the things that I don't think is going to decline, and a lot of this has to do with how many restaurants went out of business during COVID. I think it was something like 78 or 80,000 restaurants went out of business, which is not necessarily terrible for the overall market. Margins had really contracted in the restaurant business prior to COVID, and margins for restaurants look a lot better now. And I think part of that has to do with reduced competition. And I think that even if we see a modest decline in the economy, a recession, for quick serve restaurants, Restaurants focused on delivery, I think we're actually still going to do really, really well in that time period. People, that's one of those habits that just isn't going to change. But okay, folks, this is a really short live stream today. I'm not getting a lot of questions. I'm just going to hang out here for a few minutes more. If people still have questions, I'm happy to answer anything or talk about anything, including individual stocks. Didn't even look at where the market ended. We got on the live stream here. I've just been a little bit busy today. You can see I was looking up chicken wing recipes before I got online. Okay, so Dow's up 30 points today. NASDAQ up 72. Big Bear Holdings down 10%. I've been keeping an eye on that one. Tesla up 10. Oh, let's talk about what my expectations are for Tesla Investor Day. So there's a couple of things I'd like to see for Tesla Investor Day. And yeah, so a couple of things on my list for Tesla Day. Number one is I want to see what their actual progress is with their lithium refining facility. Permitting is going to be a nightmare for that. I would like to see they actually have concrete plans and cash set aside to acquire a lithium miner. I cannot impress upon you how much this is going to be a concern for companies going forward. I think in a lot of cases, and Tesla is right to get ahead on this, is that they're not going to be able to rely on miners, like just buying directly from miners. There's actually going to be too much competition for raw materials. And they're best on their own just to supply what they need for their own battery manufacture. That's number one. So I expect to hear about an acquisition of a lithium mining company at some point. I also would like to see, but I don't expect to see, a cheaper version of a Tesla coming out. Tesla is running into a problem right now. It's that not the problem is that all of their autos are actually really good, right? But they have a really limited lineup. They offer 4 different vehicles. The market is not getting saturated with Teslas. It's getting saturated with Model 3s and Model Ys. You can go to a grocery store right now anywhere in Southern California, and you can count, I don't know, 10 identical Model 3s in a parking lot, and it doesn't matter which neighborhood you're in, you will find a Tesla. The problem right now is that there are a lot more electric vehicles out here. There's a lot more competition. And I would not be surprised if electric vehicles are more than 15% of the market this year. I think they were 12% of the market last year. I wouldn't be surprised if here in California, it was 15% of the market, and that is going to grow. And yeah, so you're looking at Hyundai and Kia making huge inroads in terms of electric vehicles here. I'm seeing a lot more Volkswagen ID4s. I've seen one Lucid here in the wild. I've seen a couple of JAC electric vehicles as well. I saw the truck. I think I posted that. I posted that to the discussion in Discord a while back. I saw a JAC truck that wasn't electric, but now I've seen a couple of small JAC electric cars. In fact, I didn't even know they were electric till I went home and looked them up. Remember, guys, I live right on the border, so we see cars all the time that aren't sold in the United States. So I see vehicles that I don't recognize all the time driving on the road. So I'll tell you what I see: a new design. They need to refresh their models, are getting their butts handed to them in China when it comes to a lower scale mass market model. When you look at BYD, they have the BYD Seagull coming out where it's going to retail between $9,000 and $14,000. It's a hatchback. It's a 4-door hatchback. I think it's a 4-door hatchback with a lithium iron phosphate battery on it that you can get for $9,000. It doesn't have all the greatest bells and whistles, but it's a great entry-level vehicle for someone with a little bit of money. It's going to be cheaper than any internal combustion engine vehicle in its class in China because of their licensing requirements. So the Tesla is actually going to get a rear for them in terms of business by BYD in China if they don't start moving their way down the value chain. They've managed to really upset the markets and the markets that they are competing in right now with their price declines. It's really affected Xpeng's deliveries, and I think it's affected NIO's deliveries to a lesser degree. But BYD was basically unaffected by Tesla's price declines because they're still those prices for a lot of their vehicles. Now, I think that the Model 3 is a much better vehicle than the BYD Han, but I don't think that the average person who just wants to have a nice car, wants to have an electric car, And I don't think that they necessarily see the same things that I do when I'm looking at a vehicle. And the BYD Han may be good enough for them, especially at the price point that the Han is sold at, which is lower than the Tesla Model 3 is, and that's who they're competing against in China. So yeah, so BYD is actually on my watch list for a market decline, Michael. And so what's on my watch list should not necessarily be what's on your watch list. You would need to make sure that your time horizon aligns with mine. I buy a lot of good companies that are really risky, and I have a really long time horizon. And honestly, it's the long time horizon that makes most of these bets successful. It's not genius on the part of when I'm particularly buying or what have you. I'm looking at long term trends. So I am still looking a lot at genomics. And right now is one of the best times to buy any sort of ETF that's focused on genomics. So, I mean, CRISPR will end up being one of the, not CRISPR the company, but the CRISPR technology using the Cas9 techniques to edit a genome of living creatures. That's probably going to be the most impactful human discovery since the theory of relativity. And I just watched a YouTube video yesterday on relativity, and now I'm stupid for having watched it. But I talked about how relativity and quantum mechanics are all lies and they can't be true. And this person, I guess, doesn't realize that you live in a world that is built on relativity and quantum mechanics, meaning that all of our electronics technology that depends on using anything from outer space, satellites, anything like that, all of our electronics, literally use quantum mechanics all the time. And it's the understanding of how to use quantum mechanics fuels our modern economy, right? But after watching that video, I realized what a terrible, terrible job our education system is doing on teaching people about cosmology and standard model of the universe. We're also doing a really terrible job of educating people on how important not the human gene is, but DNA is as an information storage mechanism, and as a protein synthesis method, not just for living creatures. So genetic manipulation 10, 20, 30 years from now is going to be the biggest moneymaker that the world has ever seen. Like more than natural gas, more than oil, more than anything. And how that market looks, I don't know. Which companies are going to be winning? I think it's only 8 or 9 years away before most of the patents originally put on the CRISPR process are going to expire. They're all going to be available to the public, and at that point, we are likely to see. And it may not be that that's the only technology around to allow gene editing, but yeah. Let me see. Hey, Ben, by mistake, watched your Neo video from 2 years ago. You had no gray hair back then. Welcome to the club. Have you basically kept the same view in regards to risk, Neo being? Yeah, I kept. I mean, there's always a premium associated with not a premium. There's always a discount associated with any company that you buy in China because of political instability. And not the political instability you're thinking about where the country would disappear, upheaval or something like that, but really just the idea that the leaders of the company suddenly become politically unpopular and lose the support of local or national officials, and that ruins the company to a lot of degrees. They remove the talented assets they had in before, and then they put people in those companies that are basically party lackeys, and the company never performs. And this has happened over and over and over. And I think that's actually pretty interesting. And so, yeah, that's always been a risk. My risk with Neo has really been that when they got involved in 2019 with Neo, they created this owner's agreement with JAC. The hands in the cookie jar are already there when it comes, and they're already there to every company with to a degree, but they're already really there when it comes to Neo. And I think that that's going to limit their innovation in the long run, and it's going to limit what they're able to do with the strategy in the long run as well. I think that if you wanted to go with the least risky investment when it comes to China, that's probably going to be BYD. If you want to go with a little bit more risk, there's actually lots of other companies out there now traded publicly besides Neo, Xpeng, Lee, and BYD. There are more out there. You have to go look for them. But the other thing that no one's talking about is that Neo, Xpeng, and Lee are nowhere near the largest EV producers in China, and they may not be near in terms of technology. There are lots of companies out there that have funding that are not traded on US exchanges, that are not covered by Western media, that are selling 10,000 vehicles a month in terms of EVs or more. So it may be that they simply get outcompeted over time. I don't really know. You see, no matter what Tesla says Wednesday, the street won't like it. I think so. I think you're right about that. You're generally right about things, Bram. But I think that's actually true. But and the reason I say that is because it's generally true. It's only been a few times when we have one of these investor days that where the market actually hangs on to the game Tesla. Usually we see this fairly significant run up in Tesla price for one of these significant events, and then we see decline afterwards. And it's entirely possible that in the run up, in the immediate of day, that Tesla's going to go through to the 90 and the 170 all the time, until we have greater clarity on some of the things that people are worried about right now in terms of demand and competition. I think that the biggest worry for me right now is not short term with Tesla; it's long term. It's how are they going to get to that next level of super production, which is something that's supposed to be addressed in the investor day on Wednesday. Michael Will says, I looked at CATL release on sodium ion battery and they can be mixed with lithium ion batteries and packs. Yeah, I'm not okay. So I'm not trying to insult you here at all, but I'm not sure why you find that to be surprising. They are just battery cells that put out electricity. You can combine a lot of things that are close in terms of voltage output. You could put them all in the same battery pack. Because remember, it's just thousands of those little tiny cells that are in there now. 4680s aren't little tiny anymore. But yeah, there's no reason why you couldn't do that. The only reason you couldn't do that with a lead acid or nickel cadmium batteries, because the voltage difference, while it's not that different with the individual cell, when you aggregate those cells together, the voltage difference was large enough that mixing those in battery packs in numbers that weren't exact would have caused enough variation in the voltage that some systems may have had a problem with it. So the reason you can do that with the sodium ion battery pack and most of their lithium ion packs, and it really depends on the higher average voltage, is the average voltage between the two is close enough to where you could vary the number of sodium ion and the number of lithium ion cells in there, and the voltage wouldn't be enough to damage electronics. That's the only reason it looks good. So we're going to see sodium ion battery packs take over the industry in terms of large scale application, in terms of stationary applications that are absolutely going to take over the industry just based on cost and chemistry, and availability. They will take over everything for stationary battery packs. They're probably going to take over everything, sodium ion battery packs, for everything in the lower end of vehicles, meaning your mass market vehicles and all that, where you are not willing to pay the premium price for a lithium ion battery. What was it? I haven't looked in a couple of weeks, but lithium was like 90,000 a ton or something in September, and sodium was like 3,000 a ton. So huge difference in price there when it comes to the materials on there. So you probably are going to see some mixing and matching in there. The issue with sodium is that in a lot of ways, it's not in terms of energy density, but in terms of cycle life, in terms of operability in cold weather, in terms of charging times. But it's actually better than your lithium ion battery packs. In terms of weight and energy density, it is not. So we're still going to see mixed applications between the two, and we're going to see probably price divergence on those battery packs and application divergence on those battery packs. So let me see here. Let me see. Oh, I asked you previously when you spoke about batteries and you said you didn't know. That's why I looked it up. I don't remember that incident. Uh, yeah, I don't remember that incident, but I must have looked it up in the intervening time period as well, and then just assumed that everyone else did. I apologize for that. Bit of arrogance on my part. Let me see here. Let me see if I missed anything else. Um, let me see. What do I think about the Nasdaq? Uh, I think that the Nasdaq is in for a rough ride, less so or more so than the S&P 500. I think the S&P 500 is going to be a bit more stable between now and the end of June. I think the Nasdaq is in for a rough ride. I think that people just haven't look. There's a lot of smaller companies that I liked last year that now I realize that their stock price has dropped so far that their outstanding debt already is larger than the total value of their outstanding stock, which means that it's going to be extremely difficult for them to borrow money. It's going to be extremely difficult for them to raise cash or impossible for them to raise cash with a secondary offering. And there's a lot less appetite for secondary offerings anyway, which means that they're going to be reliant on doing business and making a profit in order to raise additional cash for expansion, which means the growth is going to slow for a lot of, particularly a lot of fintechs on the NASDAQ. It's going to slow for a lot of technology companies on the NASDAQ. But the companies that are doing well in terms of their ability to source cash, those are the companies that are going to do exceptionally well out of this time period. And they're going to absolutely explode 6 to 9 months after there is a Fed pivot on interest rates. And SoFi is one of those companies that I'm really looking at. They have zero problem gathering deposits right now and being able to focus on growing their business. That's one of the things that's going on there. So, yep. So you mentioned being loose with their numbers. So it's not necessarily being okay. Yes, loose with their numbers, but that's not necessarily what I'm criticizing here. Is that they have a lack of standardization when it comes to reporting, and it may not even be that there's a lack of standardization. It's just different than the way we standardize things, and it's caused an opportunity for a number of frauds for companies that were based in China but listed here in the United States. There actually have been more companies kicked off of exchanges here in the United States due to reasons involving fraud than there are companies that are actually still on exchanges here. So that is actually the case. There are all kinds of companies that report things that are full in line with the principles, and these are your larger plays here. But most of your smaller Chinese companies, they're not really giving us numbers that are within our generally accepted accounting principles, right? Which basically means that number one, it may just be that that our analysts have a hard time putting those or making those numbers relevant or understanding those numbers in terms that investors like here, or it does provide opportunity for fraud as well. So the street doesn't like bigger picture things. They're more interested in here now, and investors tend to back the story. Yeah, that's true. And I realize I'm not doing myself any favors with this channel by talking about, big things like the difference between AAA rated corporate bond yields relative to yield on a 10-year treasury and constant maturity. I realize I'm not doing myself a favor by talking about this, even though it's probably one of the most important things happening in the market right now. That if we see a significant downturn in the market, we're nowhere close to where it would be in terms of max pessimism, not even close. So if the market really kind of breaks through the 3,800 level, I would keep an eye on this spread. When this spread right here hits about 2.5%, that's when you know the market is pretty close. We see here. Hal just said, just on batteries, a colleague has a 2015 Model S using nickel, manganese, cadmium, and on a recent test, warranty expiring, it was still at the 95% capacity. I wonder how often he drives that. I'm actually surprised. I would like to know how many miles he has on that. I wouldn't, or kilometers he has on that. That would be the real test of how it is. So, yeah, recent test pre-warranty expiring, it was still sitting at 90 to 95% of its existing capacity. It's not going to be too long before we have third-party companies producing batteries for Tesla. And at that point, I think that Tesla is going to have to lower the cost of replacing their battery packs in their cars right now. But if you look at 8 years of use from a Model S using nickel manganese, that's actually longer than most people own a car. And I think that the average lifetime of a car, I want to say, was only 12 years. So what is the average lifetime average lifetime of a car? I think was only 12 years. Yeah, 12 years. It's around 12 years or 200,000 miles for a car. So that's, I mean, you're 2/3 of the way there without having to go through the cost of replacing your battery. You've not paid for a dime in gasoline since then. So 120,000 kilometers, AC charge most of the time in the garage, not fast charge option. Yeah, so he hasn't driven it very much since 2015. So there hasn't been that many cycles. So that would be amazing if he had, 800,000 kilometers on that car in that time period. I think that in this case, it's still impressive because there's natural battery degradation over time, even if you don't cycle it that much. That if it's between 90 and 95% after 2015, but he's only put 120,000 kilometers on there, which is, say, roughly 75 to 80,000 miles or something on there. Then I'm not surprised by that. Maybe my surprise is by about 5%. That's what I'm surprised by. Now, if you'd put 400,000 miles on the car at that point, the battery might be below 70% of its existing capacity. And at that point, he could choose to drive with vastly reduced range, or he could choose to replace the battery. Now, though, I don't know if you guys saw this, but the first battery storage project in California just went online, and it's 100% using used EV car batteries. But here's the thing. It's using Honda used car batteries. A lot of them are the hydride batteries and Toyota batteries. It's not even using any of the newest, most modern. It's not even using any Tesla batteries. It's using basically used electric car batteries from Honda and hybrid batteries. So I think that's very interesting as well. So it's still going to see a life. That prediction that it was going to see a life is actually coming true. Let me see. Yeah, so uses short trips and uses solar panels most of the time. Yeah. So I think even the range on that car when he bought it was still close to 400 miles when he bought it. On housing, it looks like we might have a second slow peak season in housing. Do you believe some opportunities might present themselves by year end? I think there's going to be markets that present themselves by year end, but I think it's going to be limited to certain markets. Like, I'll be honest with you. I thought that my home, because I live in Southern California, I thought that my home price would decline more than it has. And I think it's just where I live, there's nowhere left to build, right? There's like literally no available land because you're blocked by military bases to the north, mountains to the east, an international border to the south, and ocean to the west. There's just nowhere left to build, right? So, and the fact that the weather's here great, 330 days out of the year, it's perfectly sunny and beautiful. There's always going to be demand here, whether or not the economy is good, or it doesn't matter what happens. But in other markets where you don't have the geographic constriction, you're still able to build. I would think that you may see more housing declines in that. And I'm really talking about the South. There are a lot of places in the South where I think there are some long-term projects that are going to bring a lot of economic opportunity to that region. Tennessee, Georgia, and a couple of other places where we're seeing manufacturing move to. There's going to be demand for new housing in those areas. I think that the bottom is going to drop out for some existing housing, but there's going to be a lot of demand for new housing in those areas. And I do think that there may be some opportunity in those areas in the South. So South Carolina, Georgia, Tennessee, Alabama, believe it or not, I've talked about Alabama before, but with what I suspect to be generational push to develop new anti-platform technologies in the defense space, the areas around Huntsville, Alabama are likely to see sustained long-term growth in terms of real estate prices. This may be if you're in the real estate industry, this may be a tough year or two, but if you can make it this next year or two, I think you're looking at real sustained growth in economic opportunities in the Huntsville, Alabama area. And a large part of that has to do with how saturated the area is with military contractors and government money. So, I think there are some opportunities, but it's going to be location dependent. I don't think you're going to see great opportunities in New York. I don't think you're going to see great opportunities in San Francisco or great opportunities in LA. I think those areas for opportunities are going to come like in Austin, Texas, where we've already seen a significant price decline. I think it's going to come in Atlanta, Georgia, or some of the smaller cities out there. I think it's going to come around the Charleston area, but like in the North Charleston area, which right now is far less valuable than some other areas. And yeah, so I think that there's a lot of opportunities in a lot of different areas right now, but it's very much dependent on your location. And investing in an area where you don't live is scary. There's a lot that can go wrong. All right, guys, we have come up on the hour. I was actually looking to keep this a little bit shorter today, ran over as I found a few things interesting to talk about. And yeah, so 90,000 is the spot price for lithium. Contract prices are all about different. Lithium ETF was down for the last 3 months. Yep. Okay, guys, thanks so much for attending today. I'll be back with a live stream on Thursday. And like I said, I do have another video coming out this week with that kind of outlines the 6 signs that are in the 6 signs of doom, which are contrarian signs. You want to see the 6 signs of doom. And Renee Alfonso, thanks for attending today. I didn't see you at the beginning of the live stream. I will see you guys on Thursday. Have a nice day.